Hi. Let's learn about hedge funds. A hedge fund is a limited partnership of private investors whose money is managed by professional fund managers who use a wide range of strategies, including leveraging or trading of non-traditional assets, to earn above-average investment returns. Hedge fund investment is often considered a risky alternative investment choice and usually requires a high minimum investment or net worth, often targeting wealthy clients. The term hedge fund defines this investment instrument as the manager of the fund often creating a hedged bet by investing a portion of assets in the opposite direction of the fund's focus to offset any losses in its core holdings. Hedge funds use riskier strategies, leverage assets, and invest in derivatives such as options and futures. An investor in a hedge fund is commonly regarded as an accredited investor, which requires a minimum level of income or assets. Investments in hedge funds are considered illiquid as they often require investors to keep their money in the fund for at least 1 year, known as the lock-up period. Hedge funds target select investments and pools of securities primed for gains. Four common types of hedge funds include: hedge fund strategies cover a broad range of risk tolerance and investment philosophies using a large selection of investments, including debt and equity securities, commodities, currencies, derivatives, and real estate. Common hedge fund strategies are classified according to the investment style of the fund's manager and include equity, fixed income, and event-driven goals. Today, hedge funds employ a standard 2 and 20 fee system, a 2% management fee, and a 20% performance fee. The management fee is based on the net asset value of each investor's shares, so an investment of $1 million garners a $20,000 management fee that year to cover the operations of the hedge and compensate the fund manager. The performance fee is commonly 20% of profits. Hedge funds differ from mutual funds as they are not as strictly regulated by the Securities and Exchange Commission. Mutual funds are a practical, cost-efficient way to build a diversified portfolio of stocks, bonds, or short-term investments and are available to the general public and average investor. Hedge funds can only accept money from accredited investors. Hedge funds can invest in land, real estate, stocks, derivatives, and currencies, while mutual funds use stocks or bonds as their instruments for long-term investment strategies. As investors research to identify hedge funds that meet their investment goals, they often consider the fund or firm size, the track record and longevity of the fund, the minimum investment required to participate, and the redemption terms of the fund. According to the SEC, investors should also do the following when deciding to invest in a hedge fund. As of 2022, the most notable hedge funds include: investors look at the annualized rate of return to compare funds and reveal funds with high expected returns. To establish guidelines for a specific strategy, an investor can use an analytical software package such as hedge funds, mutual funds, and exchange-traded funds. All are pools of money contributed by many investors that aim to earn a profit for themselves and their clients. A wealthy individual who can afford to diversify into a hedge fund might be attracted to the reputation of its manager, the specific assets in which the fund is invested, or the unique strategy that it employs. Hedge fund investment is considered a risky alternative investment choice and requires a high minimum investment or net worth from accredited investors. Hedge fund strategies include investment in debt and equity securities, commodities, currencies, derivatives, and real estate. Hedge funds are loosely regulated by the SEC and earn money from their 2% management fee and 20% performance fee structure. Here are 4 key takeaways. 1. Hedge funds are actively managed alternative investments that commonly use risky investment strategies. 2. Hedge fund investment requires a high minimum investment or net worth from accredited investors. 3. Hedge funds charge higher fees than conventional investment funds. 4. Common hedge fund strategies depend on the fund manager and include equity, fixed income, and event-driven goals. Hope this would help. Thanks for watching.